the US government bond market is blowing raspberries at the Federal Reserve. Now this could indicate trouble ahead for the American economy. The Fed lifted interest rates for the first time in 9 years in December, and short-term bond yields have duly climbed higher. But longer-term Treasury bonds have shrugged, with the yields actually falling since the US central bank tightened monetary policy. In financial jargon, the Treasury yield curve is flattening, the difference between shorter and longer-term bond yields narrowing sharply. The spread between the 2- and the 10-year Treasury yields is now below 1.2%, close to the smallest gap since 2008. In part, this compression merely reflects the fact that whilst the Fed is master of short-term interest rates, it enjoys little direct control over longer-dated bonds. These tend to trade based on the ebb and flow of fundamental factors, such as inflation and supply and demand. With the concerns over the global economy still elevated, the inflation outlook subdued, and even lower yields on bonds issued by other major governments, investor appetite for US government debt remains strong. The recent Chinese turmoil has stoked demand even further. Meanwhile, Treasury bond supply is going to shrink as the US budget deficit falls and Treasury bill issuance climbs. The curve flattening also reflects the fact that many investors scoff at the Fed's plans to lift interest rates another 4 times in 2016. Now, even if the central bank does follow through on its plans, many fund managers and analysts predict that this will just compress the yield curve further, as short-dated bond yields rise in tandem, whilst longer maturity debt stays subdued due to the global pursuit of bond market returns. However, a flatter yield curve is also a classic omen of an economic recession, which some more pessimistic analysts fret could come already in 2016. It's been a spluttering, muted recovery. The US economic expansion has now lasted for 79 months, making it the 5th longest expansion since 1854. Expansions don't die of old age, but there are enough warning signals flashing yellow. Unemployment data is strong. The ISM manufacturing index is falling to its lowest level since 2009. The corporate bond market is spluttering. The Dow Jones Transport Index, another popular bellwether, is in correction territory. These are all classic symptoms of an economic downturn that bear watching.